Now, another important risk that we have to focus on are those what we considered significant risks. In audit, significant risks are areas or risks that requires special audit consideration. Okay? So because these are the areas that would most likely, okay, more often than not, would result to material misstatement. So what can we consider as items that would pose significant risk? So usually these are the areas wherein there's a presence of fraud risk factors. So fraud risk factors, normally these are the indicators of fraud, okay, or areas where fraud normally occurs. For example, revenue of our client. So the revenue of our client would normally be considered as significant risk in most audit. Okay, kasi for one, this is the one that drives that drives the key performance indicators of the entity as a whole. So meaning if the entity would increase its revenue, then its bottom line, its profit will also increase. So thereby painting a better picture of the company's financial performance. So there is always an incentive for our client to inflate their revenue. Okay? So another is that the opportunity to commit fraud. So revenue is almost always the highest amount in the income statement or statement of comprehensive income of our client. And because of the sheer size or volume of the revenue, the opportunity to commit fraud in that particular area is viable on the part of the client. So because it would not be that easy to detect any misstatements occurring in revenue. So because of the size or volume of transactions occurring on that particular account. So that is why we have to consider those factors whenever we approach the audit of revenue of our client. So in case, let's say for example, in a particular audit engagement, we believe that the revenue does not pose significant risk. So we have to document how we were able to conclude that revenue is not considered a significant risk in that particular audit. So because as I mentioned earlier, in almost all audits, no, revenue would always will always be considered as a source of significant risk. Okay? Another item or area that would normally give rise to significant risk are those transactions that relate to recent or significant or major accounting event. Okay, for example, a business combination, okay, or impairment. So those major accounting or significant event would normally lead to significant risk or where significant risk may arise. So another, those that involve subjectivity or complexity. So like for example, accounting for derivatives or let's say involving subjectivity like what I said earlier in my example, impairment. Okay, so those would involve a high degree of subjectivity on the part of the client, therefore also source of significant risk. And another one, we have transaction with related parties. So we'll discuss it later. So because usually these transaction with related parties are not comparable with transactions with third parties. So that is why it's also a source of the significant risk. And last one, we have transactions outside the normal course of business. So for example, those transactions that lack business rationale, so that might present non-compliance with laws and regulations and therefore source of significant risk. Now, to discuss further the transaction with related parties, so the reason why we consider it as a source of a significant risk, so because of the following reason. So there are stringent disclosure requirements from different government agencies affecting related party transactions, like for example, SAC and the BIR. So therefore, the risk of non-compliance on the part of our client is high, contributing also to significant risk. And this is the reason I mentioned earlier. So usually transactions with related parties are not done on an arm's length basis. So therefore, we have to consider the substance of the transaction rather than therefore. And finally, it provides opportunity for the client to commit fraud. So sometimes transactions with related parties become a vehicle, let's say, to hide certain asset, to hide certain liabilities, or to hide certain transactions on appearing on the financial statements. So we're not saying that related party transactions are illegal per se. In fact, related party transactions are a normal feature or normal part of business activities. Okay. However, for these reasons, they become opportunity, no, for the client to commit misrepresentation on their financial statements. That is why we put particular focus on them in our audit, for the reason that they are source of significant risk. Okay? So our focus area in audit with respect to auditing related parties is that all related parties of our client should be identified. So because it will be important for us to evaluate the disclosure requirements. So material related party transactions are adequately disclosed. So meaning not all related party transactions need to be disclosed in the financial statements of our client. However, we have to consider whether those that were excluded are not material. So because what is required is that the client adequately disclose those material related party transactions. And then finally, we have to also consider whether the transactions with related parties are reflective of their economic or substance or economic form or substance, so rather than their legal form. So we have to consider that when we perform procedures related to RPT or related party transactions of our client. So our related procedures in this area involve understanding the business of our client, so the nature of their business, the investments that they make to another companies or other companies investing to our client, because that could affect related party relationship. Okay, inquiry of management. So we inquire management. For example, we ask them to provide to us. So for example, the family tree of their business, so their connection with other companies, with other shareholders. Okay, so significant information about related parties that could affect their disclosure. So we have to consider that. We can also review SEC findings of our client and the stockholder listing. So because remember, related parties are not just limited to companies. It could also be a major shareholder or stockholder or even family member of an investor or shareholder. So we have to consider that also. And we can also review unuseful transactions. So for example, those that lack business rationale or purpose, we have to consider that because that could also lead to possible related party transaction. Next, another important part of our risk assessment procedure, we have preliminary analytical procedure. So because remember earlier, we mentioned that the evidence that we obtain related to risk assessment procedures include the inquiry, inspection, and observation, and this one, performance of analytical procedures. And this one, our reference is PSA 520. So performance of analytical procedures. Now, analytical procedures, this procedure involve evaluation of financial information of our client made by study of the plausible or likely relationship among both financial and non-financial data. So meaning to say, for us to understand the mechanics or the reason why that particular account or transaction arrived in that amount, we consider not only financial data, but also non-financial data. Okay? So that's what we mean by plausible relationship. So that means possible relationship with both financial and non-financial data. Now, in analytical procedure, it encompasses investigation of fluctuations, no, or differences from the reported amount this period and prior period, and also inconsistencies with other relevant information or those that deviate from our projected or expected amount as auditor. So like for example, we compare the amounts from this period and previous period. We highlight those that have significant differences. Normally, we set a certain materiality, and any amount, let's say that exceed that threshold, would be subject to investigation. So meaning, it doesn't necessarily mean that if there's a significant difference, there's already a misstatement that occurred on that account. So, but that is warranty or that is what we call this uh, that will warrant investigation on our part if there are significant deviation or there are significant differences, no, from our expectation. Okay? So, another example of analytical procedure. So, aside from comparing present and previous figures, we can also perform trend analysis. So, wherein we compare the movement of the transaction over a period of time, let's say from year to year or from month to month. So, that is another example of analytical procedure. So, ratio analysis, wherein we compare one financial statement item to the other. So, let's say, for example, we compare the movement in the interest income or interest expense compared to the related loan. No? So, for interest income, we can compare it with the loan receivable or note receivable, and interest expense, we can compare it with the, let's say, with uh the loan payable of the client or notes payable of the client. So that is ratio analysis, okay? Or the turnover of sales by comparing the amount reported as sales and the average receivables of the client or average inventory of the client in case of inventory turnover. So that is ratio analysis. We have to understand the reasonableness of one financial statement item compared to the other. Okay? We can also perform tests of reasonableness. So in this case, we can use non-financial data. For example, for payroll expense, we can compare with the headcount of the client's personnel. So compared to their average salary or remuneration. So we can use that in testing the reasonableness of payroll expense of our client, or even sales. We can compare sales with the store space, no, of our client. So store space, if for example, is it possible for the client to generate this much sales considering the size of their warehouse, considering the size of their store? So we have to consider that also as part of our analytical procedures. Okay. So we also have more technical versions, like for example, regression analysis, wherein we use mathematical models in evaluating the reasonableness of the items presented in our client's financial statements. However, although these analytical procedures are very helpful in assessing possible risk of material misstatement, they are not a source of conclusive evidence. So meaning to say, if we have identified the, let's say, deviation from our expectation, that does not necessarily mean there is already material misstatements arising from that area. So we have to still perform additional audit procedures, no, to find out the reason of the deviation. So meaning analytical procedures are more directional in nature. So meaning it can point us to the possible risk of material misstatement, but it cannot definitely say with the definitive, or it cannot say definitely that there are misstatements that occurred in that particular item of the financial statements of our client. So they are not conclusive in nature. So that's the disadvantage or shortcoming of analytical procedures. That is why compared to more detailed audit procedures, analytical procedures are less reliable compared to, let's say, detailed testing of a particular account, transaction, or disclosure. So, but then again, it's helpful for us at this point in performing risk assessment procedure. However, performance of analytical procedures are not only performed during the risk assessment phase. So in fact, we can also perform analytical procedures in other phases of the audit, such as substantive phase and even in the evaluation of the financial statements. Okay, so that is why we perform financial statements at 3 points, no, in an audit engagement. The first one is during the planning stage, wherein it is part of the required audit procedure. In planning stage, we perform analytical procedures to obtain understanding of our client's business, to enhance our understanding of the client's business, and to assess the risk of material misstatement in line with the objective of the risk assessment procedure. Okay? So remember, during the understanding phase, we obtain understanding of the business, and by performing analytical procedures, our understanding of the business of the client will be enhanced. And because of that, it is required part of the planning stage of the audit. We can also use analytical procedures as a substantive test procedures. So in this case, the objective is different. If in planning, the objective of performing analytical procedures is to enhance our understanding of our client's business, during the substantive phase, our objective is to detect material misstatements. But as mentioned earlier, so the shortcoming or shortfall of analytical procedure is that it is less relevant because it cannot produce conclusive evidence. So that is why at this point of the audit, it's not required. It will be warranted by circumstances. Normally, we can only perform analytical procedures as a substantive test for areas that has lower risk of material misstatements. So usually we can perform this on some expense items that would not have that much of risk. So therefore, we can perform test of reasonableness, analytical procedures, so instead of detailed testing. Okay, but then again, it is warranted by circumstances. And then finally, we also perform analytical procedures during the final review stage or at the completion phase of the audit. So wherein again, the objective is different. So this time, the objective of analytical procedures is to evaluate the reasonableness of the financial statement. So whether our conclusions are in line with the evidence that we have obtained. So that is the purpose of analytical procedure during the completion phase of the audit. And again, it is required. Okay? So remember those concepts that I have discussed in this part of our discussion. So because this is something that is always being asked in the examination, no? Especially in the CPA board exam.